So this managed portfolio trust is a fund of investment trusts. And I think the main thing I want to get across to you is I've not been more optimistic about the future returns over maybe the next year or two than the life of this vehicle. It's been going 16 years now. So firstly, I'll just tell you a little bit about the trust and one or two interesting elements, which is the transfer of income between portfolios, conversion facility. That's to do with the structure, but it is quite unique in that respect. And then I'm going to get on to some valuation stuff and what's in the portfolio and why I think it stands hopefully a good chance of performing. So income transfer, exactly what is that? The managed portfolio trust has two separate portfolios, an income portfolio and a growth portfolio, and they're not connected in any way except for one thing. And I've tried to explain it here. It's not easy, but let me run through it and hopefully you get the idea. Let's imagine at the beginning of the year, the growth and the income pools are both worth exactly 100. And over the course of the year, there's no change in that. Everything stays static, the same. Really, since the word go up to actually today, the income portfolio has yielded round about 4 in gross terms. It's slightly over that just now. And the growth pool, and focused mainly on capital growth, has yielded not much, maybe 1 and a bit %. And so if you focus on the growth pool here, you'll see over the course of the year, it receives 1% yield in dividends spread throughout the year. And when they come into the growth pool, they get put on a conveyor belt across to the income pool. So that -1 becomes +1 here. And at the same time, the same amount is transferred back to the growth pool, except it's called capital. All right, so what's the effect of this? Remember, if everything stayed unchanged over the year, it means the dividend that can be paid to income shareholders is not 4 but 5. However, the NAV, the net asset value, is not 100, it's gone down 1, it's 99. But you get a bit more income because you're in the income pool. And you can see with the growth pool, it doesn't pay a dividend to shareholders, it never has done, it never will do, but you've got a little bit more in NAV. Not much, but it's a small bias. And over the years, it's been really helpful for the income pool. It's added that extra little bit of income, and it's meant I haven't had to really chase yield within the portfolio. So that's been helpful. And in terms of HMRC, all they see is what's on the right, because it's all one company. It's a conventional investment trust in that respect. So that's what the income transfer is. The conversion facility happens once a year after our AGM. And basically, you can convert from one share to another at asset value, and we keep the shares pretty close to asset value. Costs are kept to a minimum. Trust picks up the costs really for you. And under the current tax law, any conversions, and if you're not doing it within an ISA, but just hold it ordinary in a share plan, are not treated for capital gains tax purposes as a taxable event. So the idea here is that over time, circumstances for shareholders will actually change. Maybe you're a bit younger, you're focused on capital growth, but as you get a bit older, maybe the requirement for income is greater and that you think, maybe I should transfer some or all from growth to income, or sometimes from income back to growth. And that's when it happens. So it's a useful facility. It's becoming increasingly popular amongst our shareholders as well. Okay, and I said the last thing was tight control of discounts. So we launched in April 2008. Brilliant timing, just before the financial crash. But you can see there, if 0 is asset value, over time the income portfolio has generally, particularly in the last few years, traded at a very small premium. I mean, at any one time it could be at one premium, one discount, or we tend to buy in shares when they get to a 3 discount and issue at about a 1.5 premium. So that's the income portfolio. Growth portfolio, you can see there, similar also, it's kept quite close to asset value. It's currently down at about a 3 and a bit premium. And I bought in some shares on Friday, so it wouldn't surprise me if they were a bit better on Monday morning. So we do try, though, and actively buy in shares if it looks like the discount is widening or if the market has got a lot on, market makers got a lot on their book. Right, so this is what it is. It started off back in April 08, and it was just some old share plans, 2,300 shareholders, 40 million of assets. And it was a fund of investment trusts, and really thought it wouldn't last very long. But actually, various things happened. They both started performing quite well. And then we found it was popular with saving schemes. We became a rollover vehicle for another trust that came to the end of its life. And actually, you can see there, we've issued about 50 million quid's worth of shares over the last 6-7 years. And the interesting thing now is, it's still a small trust. 160 million is quite small. But 16,000 shareholders. So there's no institutions, there's no private wealth managers, don't really want them. It's all individuals. So it's all you all own it. And you can see there very quickly, average size of holding, 10 grand. So this is people who are, this is sort of really maybe often the first holding in the stock market. So it genuinely is owned by retail shareholders. Now, a bit on investment trusts. And this chart, let me just explain to you, is the total investment trust sector relative to the all-share index. So if the line is rising, investment companies as a sector are outperforming. And the reverse is true when it's falling. So you can see I started it 10 years ago. And actually, you know, first 6 years, trusts were gently outperforming. It was a good place to be. Then it became a very good place to be in 2019. You could see it really went up very strongly. But just as some of the other people today have been speaking about, when interest rates, inflation took off, interest rates started rising at the end of 2021, well, you can see the massive underperformance that the investment company sector, and really alternatives, listed, they all underperformed quite substantially. Then more recently, you could see kind of a bottoming out, and actually, in recent months, encouragingly, some good signs of outperformance. So that's the sector, and oops. Just on discounts, I thought you might be interested in this. Again, this is the last decade, and this is the average sector discount for investment trusts. You can see, again, how it was kind of about 5 for long enough, really. Then the spike down with COVID and back up again a week or two later. And actually, in 2020, a couple of times, the sector was almost at a premium, which is unheard of. But then what happened, I told you about interest rates going up and inflation, and you can see the massive de-rating that happened. So that, and I've tried to actually blow that up for you the last kind of couple of years on the right-hand side. It went from a 2 discount, and at the end of October, a 19 discount. And that's the widest it's ever been this century. And currently, it's tightened in a bit, but it's still 15. So historically, that's very wide. And that's one of the reasons why it's a very, very interesting time to consider investment companies and indeed the managed portfolio trust. So now, just a word on, this is about the income portfolio and just about its dividend. I did this a few weeks ago, 2-3 weeks ago. Yield on the all-share index, I think that says 3.9. Yield on government bonds, 4.4. Yield on our share price is 6.3. And you can see here the dividend record, it's been going up. We're now at next generation dividend hero, which means we've had 10 years of consecutive increases. The first half dividend was up nearly 8%. We had a meeting with the board on Thursday. The third quarter dividend is also up 8%. We pay quarterly dividends. So you've got quite a healthy yield there. And actually, the dividend and the outlook for dividends, I think, is quite positive. So just that's specifically on the income portfolio for you. Right, now performance. And this is up to the end of January. And so let's just have a look at this. I've got the income portfolio, the net asset value, the growth portfolio, and the all-share index. And so over 1 year, you can see how the growth portfolio and the all-share were about level pegging. Actually, at the end of February, it's now ahead. But the income portfolio was definitely lagging. Actually, courtesy of what James was talking about, some of the renewables and infrastructure stocks has really underperformed. Not in terms of their dividends, but in terms of their share prices. And that hasn't helped the income portfolio. But that big D rating I showed you, remember when I showed the line coming, there you had to see it in the 5-year numbers. They're both well behind that of the all-share index. And really, 2022, most of 23 wasn't good. And it even has affected some of the 10-year numbers, although the growth portfolio is still looking ahead. And since inception over 16 years, they're now both slightly ahead of the all-share. But what's interesting is this. Actually, the 3 months to end January, and actually February has also been a good month. You can see the all-share was up 6. And the income portfolio, but particularly the growth portfolio, was up 12. So to put that into context, the year end for this trust is May. And for the first half, I think the growth portfolio was 7 points behind the all-share. And as I stand today, it's about 2 points ahead. So that's a real serious turnaround here. And this is why it's a very interesting time to look at investment trusts, because I think things are changing now. You've got fantastic value. And so what I thought I would do, I have to put this up. This is every single year's performance. It's far too much. It's too busy. But why don't you look at, see the growth NAV here. And if you start in 2013, and look at the all-share. For 9 consecutive years, we beat the all-share. And then 20 points behind in 2022. And that's courtesy of that massive derating of trusts that I tried to explain to you. And the income portfolio, similar, just not quite as great in terms of magnitude. So that puts in perspective for you the returns. So they were good. They then lost a lot over a couple of years, 2022 and 2023, and now it's really looking quite interesting. So this is what's reflected in the portfolios just now. And I think these are 3 very interesting investment themes for 2024 and beyond. First one, I have been buying a lot of UK equity trusts, particularly ones that have got a decent exposure to mid and small caps, like Mercantile, which I listened to today. I think that's a super trust. The UK market is unloved, is very inexpensive, and discounts are wide. Private equity trusts, well, their discounts are very wide. Some of them were up to 40% and more, courtesy of interest rates going up in particular, inflation being high, and the expectation that the asset values were going to fall because weren't we going to go into a nasty recession? Well, surprisingly, we haven't gone into a nasty recession. Asset values have actually been not bad for most trusts over the last couple of years, but discounts are still 30, 40% are common. Some really good managers. And over the long run, these trusts outperform the all-share index, almost all of them. As a sector, it's somewhere you want to be. And I think they're offering fantastic value. And then this one, what I've called trusts with secular growth characteristics, that's typically technology, healthcare, biotechnology. They also are at wide discounts, and they've got some really, and they've been powering the trust actually in recent months, and I'll come and show you that just now. But you want to have, definitely want to have a decent chunk in this area, because over the long run, that's where you often make multiple times your money. Right, so this is the top 10 of the growth portfolio, and so the biggest holding is private equity trust, which is mainly invested in software companies. Polar Cap Tech and Allianz Tech are up 25–30% in the last 3 months. Really strong moves. Look at the UK ones here. Fidelity Special Values. The PE of that portfolio is 8. I mean, 8. You know, so you're not going to lose a lot, really, unless we go into a very serious recession. And I think that's an interesting one. Nick Train's Finsbury Growth, Law Debenture, that's a well-run trust also. And some of the secular growth names, Monks, Worldwide Healthcare. And this is an interesting one too, called Aurora. Not for the faint-hearted. It's quite a focused trust. There's only 15 holdings. But again, it's a play on the UK market, and it's done very well of late. So that's how I've tried to reflect these themes in the growth portfolio for you. And that's what I've bought, really, over the last 6 months or so. So again, you can see I've taken a position in Aberforth smaller companies, which has got a value-orientated investment approach. They've been going for 30-odd years. There's a lot of them. They do a lot of due diligence. The PE on that portfolio is 7. Shares are on a 12 discount, so actually you're getting in a PE of 6. So unless the E falls away significantly, that's incredibly cheap. And big holding in Wincanton, which funnily enough got bought this week. There'll be a lot of M&A in these trusts. Same for Henderson Smallers. I added to the 2 technology trusts last year, and they've come through strongly. And actually, look, Scottish Mortgage, I think that's quite interesting now. It's been a very poor performer the last couple of years, phenomenal performer over 10 years. And I think actually it's now looking quite interesting. And then you see a couple of private equity trusts. I mean, Pantheon has done extremely well. It's been buying in a lot of shares on a 40 discount, which is helpful for the NAV. And it's got a really good record. It listed in 1987, and it's compounded its net asset value at 13% per annum. I mean, and it's on a 35 discount. So I've taken a big position in Pantheon. The income portfolio, I've tried where I can to reflect these themes. So there's, you can see Mercantile there. And, you know, JP Morgan Global Growth and Income is just presenting out there. I think that's a great trust. I've got a big position in that. So UK equity, I've even managed to get a private equity trust in there. They pay a dividend out of capital. And the other one I've got is Apax, which is just outside this, which I think also is an interesting trust as well. So, you know, and you can see the yields there. But the dividend growth coming through from some of these is really, I'm heartened by. And that's what I've been buying here. International Biotechnology Trust, more Mercantile. And then this one has been my most recent purchase that JP Morgan have done. They pushed their small cap and mid cap trusts together under the same management team, and they've attached a 4% yield to the shares. They probably yielded, I suspect, a couple of percent, but they pay part of that dividend out of capital. But, you know, listen, it ticks all the boxes. Small cap, income. So that is a big holding now already in the trust. So as I come to 2.5 minutes to go, prospects for 2024. I'm not going to go through all this, but why don't you look at valuations? Price-earnings ratio is one of the most common ways of valuing a company or indeed a market in investment. And what I've got there are the next 12-month consensus estimates for the S&P 500 is at nearly 21 times. The long-term average is 16. America is expensive. Europe is about par. And guess what's cheapest? Well, the UK's long-term average is 14, and it's currently on 10.8 times. That's why UK equity trusts, I think, are looking really interesting. So that's what I've been trying to reflect for you in the portfolio. But just one final thing, I thought I'd include this, you might be interested. This is the growth portfolio, and it just reminds me that in the long term, and we try and invest for the long term, it's trusts invested in these sectors that will make you multiple times your money. So Allianz Tech, look, when I bought it, I've added a small amount last year. It's an 8-bagger. Polar Cap Tech, 6-bagger, 6 times your money. JP Morgan American, the same. Biotech Growth Trust, and that was horrible for a couple of years, still made 4 times our money. And even good old Scottish Mortgage, despite having been 15 quid a share and now £7.50, still made 3 times my money on that. So if you hold some of these over the long run, they will deliver for you. And that's HG Capital, our biggest holding, has done quite nicely. So just last page, just to summarize things for you. Growth portfolio, long-term secular growth characteristics, which is popular, often investing for children or grandchildren, whereas the income portfolio will give you steadily rising dividends. I mean, 7-8% off a 6% yield is reasonably attractive, and it's designed as a long-term savings vehicle. So there you go, and there I go, 20 minutes exactly. There we are. So thank you.